Here's today's market update.
2020 has been full of challenges, we all know that, but there are a few financial statistics to be thankful for this year, including that record-breaking day for the Dow. Chase Wilsey from Wilsey Asset Management joining us now with more. Chase, good morning.
Good morning.
All right, let's get to that historic day yesterday, passing the 30,000 mark for the very first time. Put that into perspective for us. The Dow up about a 1.5% yesterday, crossing the 30,000. What does that mean?
I mean, it's great news. I mean, you go back to March, April of this year, nobody would have thought that we would have been at these levels. I mean, unfortunately, you saw people panicking and selling. I got to get out of the stock market. I mean, we know you can't time the stock market because a lot of the emotions already baked into that market downturn. And seeing this reversal and actually being positive for the year and at record-breaking levels, I mean, it's phenomenal. We have to be thankful for this. You look at the lows that we saw back in March. I mean, the S&P 500, which I look at as well as another kind of broader-based market, it's up about 65% from that lowest level. If you cashed in at the bottom, you missed out on these huge, huge gains. Again, don't try and time the stock market. It doesn't work.
It never works. It's very emotional for people. Like you said, look, you feel a certain way, you sell. You feel another way, you buy. What do you think was causing this in particular?
The climb here or the decline?
The climb.
The climb, so a lot of the climb is quite interesting. If you look at how the stock market has actually worked over the last several months, you've seen a lot of leadership in the technology names. You know, the names like Amazon, Apple, Microsoft, these stay-at-home stocks. I mean, look at companies like Zoom, they've soared this year. The tech sector has really driven us to these new heights in the market, which is the reason that we are seeing a lot of these market highs. But also what we've started to see now is what I'll call the stay-at-home stocks, the vaccine plays, you know, your retailers, your financials, they're starting to actually catch back up now to a lot of the tech stocks that we saw rise at the beginning of the year. And that's, I think, continuing this stock market climb.
During a transition of power, what happens to the stocks traditionally and historically as we start a new presidency, as we will here in the next 2 months?
You know, politics, I think, play way too much of a impact on people's emotions with the stock market. I mean, you look back to 2016, oh my gosh, Donald Trump is president, I got to sell and get out of here. And then you look at it now this year, oh my gosh, Joe Biden appears to have won the election, he's won the election, oh my gosh, we got to sell and get out of it. The politics really do not play as big of a role as people think on it. And there's all these statistics that kind of manipulate, you know, people's beliefs on that. But you look back over the last several years, I mean, there's really not as many presidential elections as people make it seem to be. So it's more of a correlation without causation, in my opinion. And again, don't play the politics. Businesses are in business to make money, provide for consumers, provide for other businesses. They're not in the market to actually work for politics. And that's the big division that people have. And while they don't do well investing, they play too much in that political game. And as I said, companies will be companies, and the stock market will continue to do well, no matter who's president.
Yeah, let's talk about the job market, because despite all the numbers and the 30,000 and this and that, there's a lot of people still unemployed. A lot of people are uneasy about where their money's going to come from the end of this year into next year. Payrolls have grown more than $10 million since in the U.S. since April. What does that signify in terms of the people who are sitting out there trying to get a job and trying to move forward?
Yeah, so I mean, I do want to point out, I mean, I'm going to go back to March, April again. I mean, I would have never thought we were going to be at these levels at this point in the year. I thought it was going to take a long, long time to get back to where we are, especially there was a lot of negativity out there in the media that, oh my gosh, we're never going to get back to where we are. It's going to take years to recover. And seeing that 10 million growth in payrolls, I'm very, very optimistic about that. The unemployment rate was 14.7% back in April. Now it's at 6.9%. We also have to remember, before COVID, we were near record lows in unemployment. I mean, we're not going to get to those record lows. We can still have a good job market without being at 3.5% unemployment. I do think we've seen payrolls grow by the millions at the beginning of the resurgence from the pandemic. I think now you got to temper your expectations. It's going to grow by the hundreds of thousands rather than the millions. But don't give up. We do know that the vaccines they're looking quite nice. So we got good news from Pfizer and BioNTech and AstraZeneca and Oxford. There's a lot of different positivity out there that I think next year the economy is going to continue to improve. Again, it's not going to be at the same resurgence that we saw at the beginning, but we can still see very, very nice growth here over the next several months.
We know the 10-year note remains under 1%. Who does that help? And also moving forward into next year, What happens with interest rates?
Yeah, so I mean, this really helps a lot of different people, and it's funny too. You look at the beginning of the year, the interest rates on the 10-year note were approaching about 2%, and they hit as low as about 0.5%. So we've seen a little bit of a climb off that low, but still well below where we started the year. Who this really benefits, the 10-year note's a great proxy for, mortgage rates. We know mortgage rates are still near record lows. We know that auto loans are still really low, and that's really driven a high demand. I mean, you look at the auto sales, the home sales, those have been huge markets for the economy at this time, and I think they'll continue to do well into next year. I will give one caveat, however. Even though that the Fed has come out and said, we're going to keep interest rates lower for longer, essentially, the 10-year note and other interest rates can still move. I'm not going to tell you the 10-year note's going to go back to 2% next year, but I wouldn't be surprised to see the 10-year note around 1.25%, 1.5% next year, just as the economy is improving. Again, the mortgage rates, you're not going to see a 5-6% mortgage anytime soon, but don't be surprised if you start to see it creep up a little bit.
All right, good stuff. Chase Wilsey, we thank you as always, and happy Thanksgiving to you and the family.
Have a great Thanksgiving as well.
All right, bud. Still to come.